Bonjour. Good morning. How's everyone this morning? Bonjour. Monsieur Sever, Jefté, Francette, Ulrich, Marcel. Let's wait for more to show up, although I'm happy you're here, and I apologize again for starting a little late. Hopefully they can find the link. So did you have a chance to read the case? Great. Great, and I just sent you the notes. The notes that we will discuss with the case. And my hope is that we'll get through this and I can leave you with a few example cases that you can practice this week. I'll just wait for more to show up. Great. Good morning, Alain, Samuel, Jean. Very good. So I'll start in when one more person comes in. Oh, there you go. Okay, so let's start. Any questions about the exercise that we completed yesterday? It took us almost an hour and a half. Any questions about that exercise before I continue this exercise? Okay, no comments, so you can let me know if you have any questions about that, but I want to start reading the case. So what we're going to do, our goal is to extract from the details of this case cash flows that we can include in our analysis, in our project analysis. So I'm going to read through and highlight each of the items that we should consider. All right, whether we include them or not, we will discuss the rationale for including them. Okay, so UAir is a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAir provides jet services to cities located in US, Canada, Mexico, Europe, the Middle East, and the Caribbean. Revenues last year totaled $5 billion. So I will underline this. Okay, $5 billion. Now I'm going to look at whether this airline should operate a new line to the Bahamas. This is the objective. Okay, we want to consider opening a new line to the Bahamas. Last year, revenues totaled $5 billion. So should this amount be considered in a projected analysis? What do we usually include in our analysis? We include incremental cash flows. So these are amounts that will accrue either as an expense or revenue as a result of taking up the project. And once we determine which ones are incremental cash flows, we set them up and we figure out the present value of those future cash flows. So my question is, do the revenues from last year count as incremental cash flows? Some people think yes. So an incremental cash flow is a cash flow that results from taking on the project. Revenues last year although I can see how you think that should be included, this cash flow, this amount, $5 billion, is a result of prior operations. But taking on this project now will not affect last year's revenues. That's done, right? This is past. So this is past and should not be included. Okay, those are past revenues, and they shouldn't be included in considering this objective. But I see how you might think it should be. Maybe. Right, so you're thinking we should compare it, right? This is Monsieur Sever is saying we should include it in some way. Well, you'll see that our approach will be to identify incremental cash flows and determine if the net present value of those cash flows is a positive. That's going to be our approach. Okay, whatever happens with the other, we're going to try and include in this analysis any effects that this project will have on other operations of the airline. So in that way we include the current, the impact on the current operations. But presuming that we're going to account for that, we don't need to include the 5 billion, but you will see. It's a good point that you're making, but let me demonstrate our attempt to include the impact of this project on other operations of the firm. Okay, so last year, UAir hired a consultant to prepare a test marketing at a cost of $2 million. Given the competition, okay, wait, let me stop. So then let me underline that. Now this 2 million, actually, I'm going to erase this because I don't want that to, I'm going to highlight it. Let me do this instead. I will highlight the goal. The highlighter is okay, so that's we're considering a new line to the Bahamas. And I want to know about the 2 million. Should the 2 million be considered incremental, as an incremental cash flow? So 2 million was, we hired, last year, UAir hired a consultant to prepare test marketing analysis for $2 million. Do you think $2 million is a incremental cash flow? The $2 million spent is already spent. Just like the $5 billion earned was already earned. Or revenues already accumulated. So if we take the project or not, that will not impact these amounts. So although they seem related, this is not incremental. It's not an incremental cash flow. It's called sunk cost. Very good. Okay, so it's called sunk cost. Next, given the competition in the airline industry, the consultant recommended to maintain the new Bahamas line for only 4 years. Now, this is important for our project because this is now a 4-year project. So let's highlight that. That was not a highlighter. We need that information. Her prediction indicates that UAir can sell So she estimated, so we're using the results of the marketing, right? But we're not including the cost. So 16,000, 24,000, 30,000, 22,000 trip tickets can be sold to the Bahamas. So are these together with the, it says during the first, second, third, and fourth years of the project. And the consultant recommends that we should charge $2,000. So should these, the tickets and their unit price, so that would be $32 million in the first year. Should that be included in the analysis? Is that an incremental cash flow? $32 million in the first year? $48 million in the second year? $60 million at the end of the third? And $44 million at the end of the fourth? Very good, Jeff Day. Yes, it should be. Those are incremental revenues. Okay, so we're gonna make a note. I'll pull this to the side. Okay, so that's incremental revenue. Okay, let's continue. She forecasts that if UAir chooses to launch the new Bahamas line, it will compete with its flights to other destinations in the Caribbean. Aha! So this is going to be the impact on other operations of the firm. As a result, UAir will lose sales of 100, 200, 400, and 300 round-trip tickets to other destinations in the Caribbean, presumably because these people will prefer to go to the Bahamas, okay? So these are the lost flights, and here's their unit cost. Are these the result of the project? Are these considered incremental effects? Very good, Ulrich. Right. Okay, so you have to include all of them. And we'll call this, these are an economic cost. This is a cost. So it has to be included. We refer to this as incremental cash flows as a result of the side effect. It's a side effect of the project. So this is a loss. So this is a cost. Any questions so far? Now these flights, these flights that we're adding, that UAir is adding, they come with a cost, right? They come with an expense. It's not all revenue. There's an expense to flying 16,000 people, 24,000 people, etc. So what is the expense? Well, the CFO, I have to, hold on. So the CFO and his aides estimate that the company's average variable operating cost per round trip ticket to the Caribbean destination, including the Bahama, is $1,000. So that's the expense of conducting these flights. They note that since the airline has okay, so that's something else. So how does this also has to be included, right? This is an incremental cash flow. I'll put it on the side. So this is an incremental cash flow, and it's an expense. Very good. Well, Knoll, we're not including the $2 million from the test marketing. We are going to consider the side effects, though. We need to consider that. And we need to consider, of course, the expense. So these are the revenues. This is the expense of the flights, the additional flights. They note that since the airline has a vacant terminal, there is no need to rent an additional terminal for the proposed Bahamas line. The annual rental cost of a similar terminal is $10 million, and the CFO's team claims that having the vacant terminal will save the airline these costs every year. So how do we include this in our analysis? Is this an incremental cash flow? Jeff says no. Yes, fixed costs. Cody. Okay. We already paid for the terminal. Okay, so these are the consideration. We already paid for the terminal. Okay. Who else has a comment? Ulrich says yes. Okay, why yes? How do you explain? It's a fixed cost. We already paid for the terminal. Okay, so we already pay for the terminal, and the terminal is not being used. But what is the value of the terminal? This is the important thing. What is the value of the terminal? What is the market value of the terminal? Operating costs should be included in the analysis. Okay, Ulrich? So we don't have to pay, because airlines often rent, right? They rent terminals, but this airline has a vacant terminal. So there's no cost of renting a terminal. However, there is a market value that you need to consider here. The market value of the terminal is $10 million a year. It could be rented for $10 million a year, but because we choose to use it, we won't be renting it. That's an opportunity cost. This is an opportunity cost, actually. It has economic value or economic cost. Do you follow? So this is, although we do not have to rent a terminal, we have one, so that cost is not included in the analysis. What is included in the analysis, however, is the opportunity cost of using the terminal for ourselves and not renting it. Even though it wasn't being rented, that is irrelevant. It has value. It's just like when you hold a share of stock in a company and you value it according to what you could sell it for. It doesn't mean you're going to sell it, but it has a value, it has a market value, and that needs to be considered. So here, we could be renting it. If this is our airline, we could be renting at $10 million, so we need to include that. Okay, so that will enter as an incremental cost or opportunity cost. Okay, we can talk about that some more. All right, now we're going to deal with the IRS taxes. The airline's vice president, customer service and operations determined that for the predicted ticket sales, the airline must purchase 4 new airplanes. The UAir's purchasing department has decided the most suitable airplane is the DC-9. The cost of new DC-9 is $10 million. All right, so what is that called? Is that an incremental cash flow? Four planes at $10 million each. Is that incremental? Do we have a name for it? Remember, if the screen gets blurry, just refresh the feed. Refresh your page. The planes are going to be incremental because you have to spend $40 million on the planes. So these are incremental cash flows known as capital spending, or this would be the initial outlay, right? This is the example. This is a great example of initial outlay. This is the investment. Okay, so Jefta says, I think we should only consider the depreciation of the plane as incremental. 10 million will be an incremental if the life of the plane is only 4 years. Okay, so we have more information about the plane. We will include the expense of the plane as a cost. It's an investment, actually. It's an investment, right? So that will go in as a negative cash flow because that's out of pocket. And then also, you're right, depreciation needs to be included. So depreciation, although depreciation is not a cash flow, reduced taxes paid or tax savings as a result of depreciation is a cash flow. So we need to include that as well. So there's lots of things we need to do to address the purchase of the plane. It's still an incremental cost because it is a it's an incremental cost because it's our investment, right? It's a cash outflow. We need to consider that we spent 40 million. I know what you mean about the asset, and we're going to deal with that. We're going to deal with the effect of having the asset and the tax treatment of it. Okay, so here's information about IRS. The IRS includes airplanes in the 7-year depreciation period. So we will use depreciation, this information, and I've given you the table that I call the maker's table that provides the depreciation rate in a particular way, and I'll explain to you how to use those. So some of you, you've taken accounting or you're accountants, so you might know how to deal with this. The maker's tables facilitate easy calculation of the depreciation. So the point is that this company purchases $40 million of planes as an asset, and over the 4 years of the project, there's wear and tear on the planes that is perceived as a result of generous IRS, the Internal Revenue Services, considers that you as a firm can account for those losses as a cost and reduce your taxable income. So depreciation must be computed, and we use the depreciation to determine what the tax savings will be. All right, so the table indicates, let me see if I can get the table up. This is the table here. So I sent you this as well. So this is a 28 point, let me get that back, 1 second, 28.6. So this is 28.6. Sorry, I'm going to go back again. It says 28.6 is the appropriate double declining balance depreciation rate. But in the first year, you're only allowed to depreciate half the amount. So that's why in the table you see that it's double declining from 28%, 28.6%, but the first year is only half that you're allowed to depreciate. And that is because it's created that way. And you'll notice the other rates are similar. These are half of the double decline rate. This is to disincentivize firms from purchasing assets on December 31st. If they were to wait the entire year and purchase assets right before year end, they could claim depreciation for the entire year, but then start the new year with a brand new asset. So to avoid that, there's just you only get half. The incentive is not so great. You only get half the depreciation. You could still do that, but you only earn half the depreciation rate in the first year. Okay, about the plane. Okay, so the question about the plane. Would we consider all the 10 million as incremental if the plane has a residual value and that we're going to sell it after 4 years? Yes, we're going to deal with all of that, Jeff Day. All excellent questions. So it's going to be 10 million. The residual value will be incremental. I will show you. You're already ahead of me. So yes, I will demonstrate what we're going to do with that, because you understand there is a residual value and there is a sale if you read the case. So okay, let's continue. So we're going to use that column of depreciation rates, and it's just explained here how it's derived in the maker's table, okay? Until the switch to straight line depreciation in the 5th year. A DC-9 lasts for 30 years before it's scrapped, and the airline's purchasing department predicts that after 4 years, each plane can be sold for $3 million. All right, so the planes are going to be purchased for a 4-year project. We're going to depreciate them on a 7-year depreciation timeline. However, the fact is that the planes last up to 30 years, okay? So they can be sold. So it's estimated that they could be sold for $3 million at the end of the 4 years. So these were, you can see the amount of estimation that goes into calculating cash flows. And you could have alternate sets of data or facts about the case and recompute the capital budgeting results. Okay, so you could recompute and come up with a different analysis, and you could argue or debate which one is a better one. But again, this is all made up of estimates, so keep that in mind. There's lots of considerations that go into this. I'm just giving it to you, but yes, you could consider other things to include. All right, so given this information, what's left? So let me underline this. So we call this, as you said, the residual value or the salvage value. We can refer to it as residual. Okay, let me make some notes here first. I'm going to make some notes along the side that we mentioned that the capital spending, the initial outlay of the planes is an incremental cash flow, but also we're going to include as incremental cash flows tax savings from depreciation. Depreciation is not a cash flow. Okay, depreciation is not a cash flow, but tax savings as a result of depreciation are. So this is incremental cash flow. And there's going to be things that I leave out, and I'm going to describe some other things that I leave out. The residual value will be incremental, yes. So this is the residual value here. I don't have room on the side, so I'll put it here. Okay. So the residual value or the salvage value is also incremental. How's everyone doing so far? There's lots here, but we're going to focus on this case for the duration of the class, okay? So you're going to have a lot of opportunity to clarify your understanding. All right. What's next? The CFO's team predicts that the proposed Bahamas line will require the following levels of current assets and current liabilities. So these here are just estimates of what needs to be set aside by the firm as net working capital for the project. Well, I'm calling it net working capital. I have the current assets, current liabilities, and we're going to sort out net working capital. So we need net working capital requirements are going to be incremental. I don't know, it doesn't fit. Let me do this again. Okay, these are going to be also incremental cash flows. Okay, so what we're going to have to do, what we need to do is compute net working capital requirements as incremental cash flows. So the idea is that immediately, year zero, immediately, $600,000 has to be available in inventory. So $600,000 worth of inventory. Okay, so this is the amount that has to be set aside for inventory. $1 million in cash, $1,300,000 in accounts receivable, and $1,100,000 accounts payable, and then taxes payable. So these amounts need to be set aside immediately. And then it's like a float. It needs to be there throughout, well, it's immediately, but through the next year, we want to be, so if inventory is consumed, it needs to be replenished by $600,000 worth of inventory. This is what needs to be available. Okay, so this needs to be available immediately. This needs to be available by the end of year one. So an additional $250,000 worth of inventory, an additional $550,000 of cash, etc. Okay, so by the end of year one, if these are depleted, they have to be replenished to the amount of $850,000 worth of inventory, and so on. And by the end of the project, what happens is the project folds. It ends, and these amounts are returned to the firm. Okay, so the firm is setting aside this amount of money for the project, but by the end of year four, they're recovered by the firm. Okay, so they're no longer necessary for the project because the project has ended. So in terms of net working capital, you should always have zeros in the final year of the project. Unless there's some extenuating circumstances that beyond the life of the project, you have to have inventory set aside or cash set aside. But usually you'll see this. Okay, that's really important. All right, so those are the facts of the case. And what we want to do is calculate the net present value of the proposed Bahamas project. Assume that the nominal required rate of return is 10%. As I explained last class, we usually deal with nominal rates, right? These are including the real rate with inflation. And all the above cash flows are nominal dollars. So this is just the usual case. Don't get confused. Should UAir start the new line to the Bahamas? So we're going to answer that question. Questions? Uh-oh. Well, the idea is that immediately we are anticipating this amount, okay? So we can imagine. Let's look at the one moment. I see what you mean. So this is just that, yeah, those are the amounts just set aside for working capital. Okay. So these are the notes I sent you. These are the notes I sent you. Okay. So we want to value the project. The project is like our asset, okay? And to do that, we're going to we're going to identify future incremental cash flows and compute the present value of those future cash flows. Keep in mind, cash flows are not accounting income, right? These are out-of-pocket expenses or out-of-pocket amounts and amounts that are received. So positive and negative cash flows that are realized. That's different from accounting, particularly when we talk about, well, depreciation. As I mentioned, depreciation itself is not a cash flow. Okay? Depreciation, however, impacts taxable income, and we realize tax savings, which is a cash flow. Remember, also when we valued, okay, so we're valuing a project as the present value of future cash flows. We valued a firm's equity, stock, as the present value of dividends. We didn't consider earnings, okay? And similarly, it's not depreciation that's a cash flow, but it's going to be the tax savings that result from depreciating income that are cash flows. So just to be clear, the difference between cash flows and accounting income or earnings. So a review of what we talked about in terms of incremental cash flows. For the net present value of a project, use only incremental cash flows. Is a cash flow incremental? Well, first of all, it needs to be a cash flow. And then you have to consider, is it incremental? Yes, if it occurs as a result of accepting the project. No, if it occurs independent of the decision. So for example, we talked about marketing surveys that were done. And in the past, those would not be considered incremental cash flows because they were in the past. That cost is sunk. Similarly, any research and development expenses of a project that were done in the past also considered sunk and not incremental cash flows. Some examples of opportunity costs. In our case, I referred to the terminal available that was vacant should still be looked at as having an economic cost. Although it was vacant and not being used, there was a underutilized capacity. It has a market value, and that should be included as an economic cost in our analysis. Similarly, if there was a machine required for a new project that's found in a company's warehouse, even though it's not used, it has a value, it has a market value, either for renting or it could be sold, and that needs to be considered as an economic cost in the analysis. Similarly, if a company owns an office building that it opts to use for a new project, it would have to consider the opportunity cost of using it as opposed to renting it out or selling it. Opportunity costs are distinguished from side effects. Side effects are impacts on other operations of the project, other operations of the firm that result from the project. So imagine GMC, General Motors, has a new truck, develops a new truck, or it's considering developing a new truck, and it needs to consider lost sales for other trucks that they currently produce. So maybe there's an SUV that's very similar that prospective buyers will no longer purchase an old model or different, an other known model. They'll move to the newer truck. So that has to be considered as a cost. And we call it a side effect. A project that considers advertising for a new product might increase sales of an older product. So that's a side effect, but that's like a positive side effect. All right, so this is a negative side effect. And this is a positive side effect that needs to be considered with the benefits of the project. You have to consider the costs and determine the net present value of all this. What if the economy is in a state of full employment? So a manufacturing company looking at employing staff or skilled or unskilled labor needs to attract those individuals from their other jobs. To do that, they might offer a competitive wage. Okay, so that wage increase for the new workers might affect other workers, at least if it's a large firm. You can't differentiate without pushback. You won't be able to differentiate the new staff from the old staff, and all employees' wages might have to be increased. And that increase could be perpetual. It could go on indefinitely, and that has to also be considered in the, well, it has impacts that go off into the future, right? So it has perpetual impact as a result of a labor shortage due to accepting the project. So this would be an additional cost, and the cost may be perpetual. So those are all called side effects. And I also mention allocated costs. Allocated costs are incremental cash flows only if they are due to the project. So for example, the cost of a new library in a research institute will be $100,000 this year. A different proposed capital budgeting project will increase firm revenues by 5% this year. Should $5,000 be viewed as a cost of the project for its share of the library? It should only be the case if it results from taking on the project. All right, this is what we talked about at the end of last class. Well, it was half of the class, really. I introduced the idea distinguishing between the nominal and the real rate. The relationship between the nominal and the real rates when there's inflation is known as the Fisher relation. The real rate is determined by the supply and demand in capital markets and represents the cost of borrowing and lending. The nominal rate is the real rate adjusted for inflation. And we learned yesterday how we use these rates. Nominal cash flows should be discounted with the nominal rate, and real cash flows should be discounted with the real rate. Okay, so you might see, as in the example that I gave you, it would be important if you have cash flows that you present them as real cash flows. So you might want to present cash flows in terms of purchasing power today, because people will understand looking at those cash flows. So people like in supervisors or investors, they might understand those cash flows better if they're presented in real terms, because they know what that money can buy today, so they know the purchasing power in the future. Usually, though, people just present nominal cash flows. But this is to give you the possibility, I'm teaching you this so you can include the effects of inflation. In particular, if you have a project that requires the ability to purchase certain equipment, or I explained yesterday the example of a laptop. If you need to be able to buy 1 or 10 laptops every year, you have to consider the effect of inflation. Any kind of budget that involves purchasing over a longer period of time needs to include the impact of rising prices. So, not only should you use the nominal rate with nominal cash flows and the real rate with real cash flows, you also want to use the proper rate. And keep in mind that higher risk cash flows require a higher return, okay? So we're going to learn, after we cover this material, we're going to start talking about estimating discount rates. So you can see, before we began this topic of capital budgeting, I was just giving you a schedule of cash flows and a discount rate. Now we're going deeper. We're going to spend some time learning how to derive our own set of cash flows, still given a discount rate. And then after we're done this, we're going to talk about actually determining the discount rate that we should be using for valuation. All right, so there's this example here, but I will let you read through that, okay? Because I just gave that to you. You guys can look at that. We'll talk about that one after. We'll have a break or something. I want to start here on page 7. All right, so here we have net operating cash flow calculation. This is what we want to do in each year. Remembering, cash flow is not accounting income, okay? And you're going to see why I keep on referring to that. In each year of the project, we want to compute the net operating cash flow. This is pretty straightforward. Revenues minus expenses, or operating costs, minus taxes. That's the first equation. What I want to do is include depreciation, so you can see the impact of depreciation on cash flows, all right? So I'm going to highlight this. That's not very good, is it? Let me see if I can use. That didn't work. Okay, that's fine. What I'm going to do is take taxes and expand it. This is taxes. Taxes are derived from net revenue. Revenue minus expenses minus depreciation. And taxes are computed on this net income, or net revenue. So this is now another way to write net operating cash flows. I'm going to substitute, rather than taxes, I'm going to put this term in here. Everybody okay so far? So I've substituted taxes with this. I'm going to do something else here. Maybe this will work better. Okay, so I've derived expanding taxes let's regroup to separate the impact of depreciation, okay? That's what we want to do here. So I'm going to identify net revenue of it. Well, I'm going to pull out revenues less expenses and factor it out. Let's do one extra step for people. I'm going to do one in between step. Everybody see that? I just multiplied like that. And then I can factor out the revenues less expenses, and I refer to that as earnings before depreciation and taxes. Times this. And so let me say that's EBDT, and then when I see 1 minus TC, I say after tax. I missed the R. Got it so far? So that's earnings before depreciation and taxes, after taxes, plus, and what is this term? This is the tax shield. This is the tax savings that result from depreciation. Now the D is something we got to talk about next, because I just put a D in here and I didn't explain it, but that's how you get taxes, right? So we're going to talk about computing D. We're going to compute D. D is for depreciation. So TCD is, oh, what is TC, by the way? I have been using it and I never, so T is TC. What does the C stand for? what does the C indicate? Anyone? This is called the corporate tax rate. So the corporate tax rate is different than other tax rates. And depending on the country you live in, it could be high, it could be low. Government likes to incentivize business, and they would like to keep it low if they don't want to incentivize so much, or if they really want to chase them away, they keep it high. But no, it varies, okay? Corporate tax rate varies in different governments, and different politicians in power change tax rates for corporations. So I just want to be clear, it's the corporate tax rate. And D is depreciation, right? And what else is not clear here? Notice this is just per year, right? This is not the total. So maybe I should say, I'll say annual depreciation. This is each year. Any questions? So net operating cash flows will be after-tax earnings before depreciation and taxes, plus the tax shield. Now this is going to help me, because what I'm going to do is separate my analysis in 3 parts. I'm going to deal with income, which is this piece, tax shields, which is a separate piece, and investments separately. Okay, so these are going to be treated, there's going to be 3 parts. I'm going to refer to income as the first part, and tax shields as the third part, and in between I'm going to deal with investments. So I'm going to continue unless you have a question. We're good? Okay, I'm going to jump over this for a minute. We're going to go here. Page 9, or slide 9. I'm trying to fit. Let's see. All right, let's review the facts of the case. The cost of test marketing already spent, we said, was a sunk cost, so that's not included. The purchase of the airplanes, that will be considered an investment. The number of round trip tickets per year during 4-year life, with a ticket price and a ticket cost. So this has to be included. Now I'm going to do this, I mean, it would be easier probably to do revenues minus costs, so you use the net amount, but the presentation separates them just so you can practice doing that. But in fact, we will refer to this as income. And then, although this is not income, the impact of the lost sales, the side effect, will be included in the income portion. Well, it's going to be an impact on income, but okay. And then cash flows from the investment, this portion, I'm going to explain where these numbers come from. These come from the table where I compute net working capital requirements or net working capital investment cash flows. I will show you that this is in part of investment. And the terminal and the cost, opportunity cost of using the terminal should be part of income. It's not an income, but it's part of lost income. The UAir will sell airplanes at that amount. That's also going to go in, well, that's going to go into investment. Then I give you these details, and I have to also add one more thing. The depreciation. And tax shields. This goes in our tax saving. This becomes part of what's called tax shield. I should put it in capitals. All right, so I've divided things up like this. I'm going to deal first with income. So that's going to be number 1. Okay, so I'm going to put together those amounts in income. Then I'm going to deal with the investment quantities. And finally, I'm going to deal with the cost savings, the tax shield. Okay, take a screenshot. Okay, ready? Income. For income, we have, okay, pay attention here because you're going to get most of it, but some of it might be confusing. So here are the revenues from ticket sales. Remember, it was 16,000 tickets times $2,000 a ticket means $32 million. These are in millions, well, these are in thousands of dollars, so that's 32 million. It was 24,000 tickets in the second year times 2 million is $2,000 a ticket is $48 million. 30,000 tickets times $2,000 a ticket is 60 million, and so on. Okay, so those are the revenues. And any questions about that? So this is the worksheet for the cash flow analysis. Now, what's this? These are the lost revenues, the side effect of losing other sales, because those customers are going to instead fly to, it's predicted they're going to fly to the Bahamas. So this is again number of tickets from lost sales times the price per ticket. So far, so good? Next, the opportunity cost. This is because we do not have to purchase the terminal. This is a cost, so these are all going to be subtracted. Make a note. So it's 10 million would be the cost that we need to include because we use the terminal for this project and we don't sell or rent out the terminal. Variable costs refer to the cost of flying people out. So this is going to be the cost per ticket of having the flight attendants, having any kind of fuel, having any other products necessary for providing services, or actually having services, cleaning services. So that's the estimated cost per ticket. So this is number of tickets times cost per ticket or expense. And maybe you forgot about it, but the fact that we lose sales, also means that we'll have cost savings from those sales. There's not going to be the added variable cost of these flights any longer. I mean, it's not enough savings to offset the loss, but it still should be included in our analysis. Questions? So these are, again, tickets from the lost sales, but they're times by 1,000 because that's the cost per flight. Questions? Let's put it together. So it's done this way. I mean, I could have put them all as net amounts here, but I wanted to demonstrate how you, for people who've not done this before, how you would separate revenues and costs or expenses. So we are going to take 32,000 minus 200. Remember, these are in thousands of dollars, but it doesn't matter. We're just going to eliminate all the zeros, the 3 zeros at the end. 32,000 minus 200 minus 10,000 minus 16,000 plus 100, and we get this amount. So you can use Excel if you like. To produce these tables. No questions? So these are the amounts: earnings before depreciation and taxes. Then we compute after taxes with a 40% corporate tax rate. Should we have a 5-minute break before I continue? And you can ask me your questions. Let's take a 5-minute break.
Okay, I'm back. That was like 10 minutes. All right. Okay, so did you collect your thoughts, comments, questions? No comments? Okay. All right, so what do? We take these cash flows. We're going to do this in parts, all right? And then I'm going to show how you how you combine them for a total cash flow analysis, like the ones we've seen so far in previous questions. Okay, so this is the first part, income. I just need to discount them. And so on the basis of net income, after tax, the project analysis estimates $23,691,000. Sorry, $23,691,373.54. Okay, so that's just for part one, income. That's the present value of earnings before depreciation and taxes. Now we're going to look at investment. Okay, so this is the one that many were asking or commenting on. So first we're going to deal with the net working capital investment. An investment in net working capital represents an increase in the net working capital allocated to the project. So there's purchasing of raw materials and inventory, keeping cash reserves for unexpected expenses, an increase in accounts receivable, a decrease in accounts payable, and taxes payable will contribute to net working capital. So in order to put these all together, we start with this table, and I'm going to sum the assets minus the liabilities. Okay, so that's going to be what's called net working capital requirements, or required. When you sum these and subtract these, you get $1.6 million. This is 2.4 million. This is 3 million. This is 2.2 million. Sorry, that's supposed to be 0. Okay, so now this is what we need to do. We need to have, we estimate that immediately 1.6 million in assets needs to be allocated to this project. By the end of year 1, there should be 2.4 million. So that's a change immediately. It's 1.6 million, and then 800,000, and then 600,000, because in addition to 1.6 million, we need an extra 800,000 by the end of year 1. By the end of year 2, we need an additional, so 3 million minus 2.4 million, 600,000. And then we see that the allocation of funds is reduced by 800,000 and returned to the firm. And in the end, the full amount is recovered. Okay, so those are the changes in net working capital required. That's important because we're looking for incremental cash flows and attributable to the project. And what we want are the net working capital investment cash flows. That means, from the perspective of the firm, these are investments. So I don't have the right sign on these amounts, right? This was just to indicate how much was required, but it's going to require, from the firm's perspective, $1.6 million in investment immediately, and then an additional $800,000 in investment, and then $600,000 in investment. But they're going to recover $800,000 at the end of the 3rd year, and then all of this by the end. This was a -2. So from the firm's perspective, these are the cash flows invested. Questions? Any questions? Oh. Oh, sorry. How did you calculate? So this was inventory plus cash plus accounts receivable minus accounts payable minus taxes payable here. And that's what's done all the way through. Then I just take this amount minus this amount to get this amount. So it's just year 1 minus year 0, year 2 minus year 1, year 3 minus year 2. Thank you for the question. Is it clear? Do you see it now? So the first step is to calculate the changes, then to change the sign to reflect that it's an investment, and here it's a recovery of funds. Okay, next. So the next piece is, in terms of investment, we need to determine the D, right? We want to calculate D, depreciation, in each year. So here's the D. And I'm going to show you how to use the maker's table. The project is only 4 years. So I extract these from the maker's table for 7-year period of depreciation. And we're going to talk about what's missing. I am missing something. I'm going to leave it out, but you need to know about it. So here you have 4 years. Here you have, I've included the first year. What you need to do is take this depreciation rate and multiply it by $40 million because that's the cost of the planes. This means that within the first year, by the end of the first year, you've experienced, or you can claim, about $6 million of depreciation. So that will reduce the taxable income. And what I'm going to do what you can do here is then determine the undepreciated cost of capital. This is what remains in terms of the asset. This is what remains in value, book value. Okay, this is book value. So what did I do? I took the 40 million minus D to get this.
me write it here. You with me? And then I'm going to keep this aside for a moment. If you wanted to calculate then the tax shield for the first year, we learned that it's just a matter of multiplying the tax rate by the depreciation amount. If we depreciate $6 million, well, $5,720,000, that creates a cost savings of $2.2 million. So I multiplied 0.4 it's 40%. 0.4 multiplied by D. And you get 2 million. So you can complete this table. I'll show you. I just want to stress that the way that the maker's calculations have been prepared for you, all you have to do every time to calculate D is take D multiplied by 4 million. I keep a running tally of what happens to the book value because I need that at the end. I need to know the book value of the asset to consider the sale of the asset and the tax treatment. If I sold for less than the market value, I get to claim a loss or a cost. If I sold it for more than the market value, the book value, then I have to claim, I have to account for that in my taxes and pay taxes on the capital gains as a result of selling the asset. So we'll talk about that all in a moment. Let's continue with this chart. So let's get the next amount. So that's going to be this amount times 40 million. Later, the planes later. This is depreciation. We're going to put the planes in a moment. I need to work with the book value. I have to find the book value and then we'll put the planes in the count. So these tables, these charts right now are just going to provide information that goes into the investment consideration, okay? If you go back here, you see we made a list. So we deal with investment will be the purchase of the planes, it will be dealing with net working capital, and it will be dealing with the sale of the plane. Okay? So I will include the 40 million. Good question. All right. So let's calculate now the this is D for, so it's much higher, right? Because because of the half year rule, I was only able to depreciate half of the 28.6% rate in the first year. And then the rate declines, but it's so high relative to the first year. It's a lot. It's about $10 million in expense that I can claim. So what does that leave? Now I'm going to take the UCC. So let me write that down here. Let me correct this and say UCC minus D, because that's what this is. All right, so I'm going to do the same thing. I'm going to use the UCC, the undepreciated cost of capital. This is the book value of the asset, minus this amount for the remaining. You can also do this in Excel. Okay, so 24 million remains. Did I do it wrong? I could have done it wrong.
You guys are writing numbers. Right. Okay, good. Looks good, Francet. Very good, very good. Okay. So I'm going to calculate the tax shield now using D times the tax rate. This is how much cost savings will result from depreciating the asset. Okay. What do I calculate? Oh, D. Oh no, this is given. This is from the table. I don't have to calculate them. That's the beauty of the table. And I use a 7-year period. So the table is here. I sent it to you yesterday. It's this one. Okay. So it's the 7-year. It's a good question though. Where the heck do those numbers come from? So this is made easy. And notice the rates are so that you can, all you have to do is multiply directly. It's very easy to use. Let's continue. So I imagine your tax agency has similar tables and similar rules for depreciating an asset. So the different columns depends on the kind of asset. So planes fall under the asset class for 7-year period depreciation. Even though they're not scrapped till 30 years, that's the most that the IRS would allow a company to depreciate for. All right. So these are incentives for business, right? For business to operate. Gives them a little bit of a boost that they can save so much in the first years of the project. Okay, so next, 0.175 times 40 million. And then I subtract what's remaining from 24 million. $480,000 is 17. And now taking the D, multiply by the tax rate, that's 2,800,000. So quite a bit of savings. Let's continue. In the last year of the project, 5 million can be depreciated. leaving a book value of $12,480,000, which is really important. So that's what I needed from this chart. I also need these amounts here, but that's for part 3. So we are going to talk about putting all these amounts together, but I'm going to overlook something that's not in this, it's not in this capital budgeting analysis. I'm going to overlook the fact that we're going to sell these planes at 4 years, at the end of 4 years. But we could have continued to depreciate the asset and continued to realize tax savings. That should also go into our analysis, right? As a loss, as a economic cost of selling the asset. I did not include it here for simplicity, and you're going to see I made things very simple just so I could get through this case. But in fact, I'm going to make a note here that we ignore, and we can work on it in a different case. We're going to ignore, and we can do that, right? We make some assumptions. We're just going to ignore the lost tax shields. We're going to ignore the lost tax shields from the sale or due to the sale of the asset. Otherwise, we should include that. That should go into our calculation. What we can do is we can talk about adding that in after. Right now, let's just finish the case. For now, I'm going to leave that out. It's not a big deal, but we can see. We'll check. We'll verify that. All right, you with me? So that is what we need from here. We need these amounts, this amount for the investment portion, and this is for the tax shield. It looks like we need to discount these, but it looks like a lot of money in tax savings, isn't it? It's at least $2 million a year. Okay, so I did this. I've completed this. And okay, so now the salvage. So what do we do with the residual value or the salvage value? So we're going to sell the planes. And notice, but let's get the book value. The book value is this amount, right? For 4 planes. So let's remember that we have the book value of the 4 planes. So we've taken advantage of what the IRS allows us to claim tax or depreciation of the planes and realize tax savings. And we have the 4 planes now are worth, according to our discounting worth $12,480,000. And it turns out that we can sell the assets. If you remember back here, we're told we're able to sell for $3 million each, right? So we're going to be able to sell for $3,120,000 each. So what is that? It turns out that 3,120,000 times 4 is exactly equal to the book value. The salvage value represents the market value of the planes. In this exercise, I've set the market value equal to the book value just to make it easier for the presentation. So it looks like the market, what we can sell them for, is exactly equal to what remains. So there's no tax treatment. We're not going to have to deal with capital gains if it was sold at a higher price, and we're not going to have to deal with losses that we can claim additional tax savings for, because if we sold it for less than this amount. I made them equal. But in general, you would have to do this. You would have to realize that there's capital losses if the book value is greater than the salvage value, and there's capital gains if the salvage value is greater than the book value. So you would have to add this term to your investment consideration. In our case, we don't have to. So I've eliminated two things for simplification. So what we've done is, by the way that I've written up the case, we didn't ignore it, I just made them equal, okay, so that we don't have to deal with it. So the impact of the salvage of the fixed asset on the net present value of the project will just be the present value of the sale. We don't have to deal with taxes. All right. So hopefully that's not too confusing. So what do we have? This is the worksheet for investments. What you have are the planes. That's the cost of purchasing the planes. And then you have the sale of the plane, just the $12,480,000, nothing else. In terms of net working capital, these are the investment cash flows. And I'm going to add the word investment. Okay, so these are the investments as cash flows, and then I put them together. So this is the total investment cash flows for investment cash flows, yeah. So you get it? So what did we ignore? Just last note that we ignored here. It was convenient that the book and the market value were equal. Otherwise, we would have to add an extra term in there. So it's a simplifying assumption. Finally, we have the present value of the tax shields here. And remembering, I ignored the lost tax shields because we sell the asset. That's just to make this simpler, because you're going to see I'm going to put everything in one worksheet and make these calculations for 4 years. But really, those should be included. All right, so what do we have? Look at this. The investment cash flows amount to present value of $32 million, negative $32 million, right, for investment. So remember, we had $23 million from revenues or income, $32 million in investment. So we're at a loss, right? If it was the 26, sorry, let's put them here. It's 23 million in income after tax, 32 million in investment, and then that alone would have been a negative NPV, and we would not invest. But look, the tax shields bring us to a positive NPV with a recommendation of investing. So that's the potency of the tax shields. So we would invest in the project as we've analyzed it. If we put the lost tax shields in, as long as they don't exceed 8 million, we should be fine. Well, actually 285,000. I mean, we should do that. I'm debating. So in this case, though, we accept the Bahamas project. Any questions? So we did part 1 was income, part 2 was the investment cash flows, ICF, and part 3 were the tax shields that we calculated in the last column of the depreciation table. So Monsieur Severa says, would we use the residual value if it was the straight line method? Yes, that's what we're doing. I'm not sure of the question. I mean, we estimated the market value. I don't know if it's really going to happen. It's just an estimate. But the idea is to sell it for the book value and avoid, we avoid any additional tax that we would have to pay. When you calculate the depreciation period, I would like to display the formula for me. I'm not sure which formula you want. The formulas are here. This is depreciation. This is from the table that I gave you. And this, I explained that this is the calculated as UCC minus D. The first one is 40 million minus D. I'm not sure what other formula you need. And the tax shields are this formula here. So I'm not sure what other formula you'd like. Just remember, I already gave you the rates. They're all on the table. They've all been determined for you. You don't have to do anything fancy. It's all there. So maybe you've done this before in another way, but the maker's table provides the rates so that all you have to do is multiply them by 40 million. So many assumptions went into building this, and in particular I will have the project listed as 4 years. And what I could do is put all the cash flows together in a total project cash flow analysis so that I could get a list of the cash flows like we've seen before. This is immediately, this is the investment, right? So this includes both the investment in the planes and the net working capital investment. And then these are summing parts 1, 2, and 3 into year 1, year 2, year 3, year 4. So this creates a set of cash flows that we can analyze. Remember how I would give them and we'd calculate the IRR? So you can calculate the IRR of these or the NPV of these. You should get the same answer as we got before. So what would be the IRR of these cash flows? Have you calculated it? Any questions? Very good. So you get 10.26. So you can enter these just as thousands of dollars. That will be fine. Just remember that they are thousands of dollars. So 10.256, let's say that, 10.256. Okay. Very good. All right, so this is your first case that we've handled together. Who in the class has done something like this before? What course have you taken, or are you a budgeting analyst? Who in the class has done this before? And you can tell me if it's your first time as well. I get an idea of how many examples I need to share with you. Isn't it risky to, well, okay, so no gas, isn't it risky to accept with such a low NPV? Presumably, the R that we're using has accounted for that. It's accounted for the risk, and that's how we determine positive NPV. That's it. If you want to set an NPV and say that it has to be a certain amount, that should already be included in the information of the project. Any kind of risks, the risk of rate of return should accommodate for the risks associated with the project. So it's a good question. Isn't this low? Well, presumably you've taken account of all of that in this project analysis. You've included all the costs, and you've used the appropriate risk-adjusted rate of return. Okay, you guys are doing well for first time, really. Okay. Okay, so I gave you much more information than just a financial statement, right? Okay. So what is missing here, like I mentioned, is I didn't include the lost tax shields. So what would they have been? Let's see. Let's calculate them in and see if it affects our decision. So what I'm saying is that there are 5 more years. Well, sorry, there are 3 more years that we could depreciate the asset that we are foregoing by selling it. Right? There are 3 more years. And if we look at the tables, back to the table, we write down, this is where it returns to straight line depreciation in the maker's table. And so the rates are and we get that extra year, 7 years, but then we have the final year. So this is going to be 0.089, 0.089, 0.089, and 0.045. And we're going to continue to depreciate and see what the tax shields look like. So multiplying, it'll be the same for these 3 years, and then this is just the remainder. So that would be 40 million multiplied by 0.089. So that's $3 million that we aren't going to depreciate. 3.56. And that would leave 1 million that we forego. In the 7th year, we could have depreciated 3 million, and then this will be the same. These are all the same. So I'm just completing the table. If we included that we're not going to be able to earn these tax savings, I don't need to do the rest of the table. I just need this. And keep in mind that's going to be in year 5, 6, 7, and 8. So these need to be discounted 5, 6, 7, and 8 years. So at a rate of 10%, what did we miss in this analysis? So this would have been a negative, right? This would be lost tax shields. Would that make a difference? So we have to calculate lost tax shields. And you can use your calculator to do it, just you have to put zeros in the CF keys. You'd have to put zeros, a frequency of four zeros. So the question is it okay that we eliminated or ignored this? Or should it be part of our analysis? Is it going to change our decision? Shall this change our decision? Will this change our decision?
What do you get? So again, the logic is, wait a second, if we sell the planes, we are foregoing these losses. We're foregoing these cost savings. But maybe it's more complicated than that because we have to upkeep the planes and there's other considerations, right? Because the project ended at 4 years, but if we just exclusively think about the lost tax shields, it's quite a bit. This is about $2 million. It's $3 million almost. But we're going to leave it out of the analysis. And you'll see I refer to this case throughout the course, but we're just going to leave it out. Because we would have to think about also how to account for and store those planes. And we haven't done that by just looking at lost tax shields. I hope you follow me. To enter this into the calculator, I would, it would be 0 as the initial cash flow, and then the first cash flow would be a 0 as well, and I would put it in for 4 periods, and then I see the amount was 1,424,000 3 times. And I'm going to put that in for 3 times. And then the last amount is 720,000. And I'm done. So 0, and then 4 zeros, and then 3, 1,424,000, and then just one of these for the 8th year. And finally, I ask for NPV, and I enter 10%, and NPV compute. It's $2,754,000. So it's quite high, but we'd have to think we're going to lose. These are lost savings, but we have to think maybe the storage of the planes, etc., will wipe out any kind of savings to consider. So we just ignore them. Okay, we don't consider them in the project. So 2,754,625. I need to make that better. 2,754,000. So we make executive decisions about how to deal with these assumptions, but if this is the amount that we're foregoing by not including, or by selling the planes. But we just imagine that storing the planes
would far outweigh the cost of any benefit of keeping the tax shields anyway. So we're going to just ignore the lost tax shields. Okay. And I will do that throughout. But if you see that if you're conducting a project of budgeting, capital budgeting analysis yourself, that's something to consider including. All right, it's 11:47. I am going to leave you with these notes. I'm going to send you some cases to practice, and you can practice reading through them. I will send them with solutions to work with Taylor, also to work on your own, and then I will send you the assignment for the week as well. All right? The assignment will include some problems from our discussion of different techniques, included the internal rate of return for valuing cash flows or projects. And it will also include at least one question from the original material we did the first week. Just one last point before we go. I asked you to calculate the IRR for this project. And how do you conclude? The internal rate of return of the project is 10.256, which is better than the required rate of return. So it's the same result or same conclusion. You should invest. It will give you the same answer, of course. Okay, there are a few other pages of the notes you can read through, and we can discuss them next week. Does anyone have any questions for me before I go? I'll stay here to answer questions for a little bit. So I'll be sending you some problems to practice with solutions. I know it's a lot of material, it always is. But if you have any questions, you have me. You can write me. I know some of you have contacted me, and I've tried my best to answer questions. Sometimes the questions come too late, and I miss them before I end up seeing you. So I apologize, but you should feel free to ask me questions. Okay. Have a good week, Samuel. Bonsoir. Bye.